Welcome to Retirement Ramblings. I'm Scott, and today is day 288 in my countdown to retirement. Well, today is Fed Day, so I spent a good portion of the afternoon after work catching up. I recorded Jerome Powell's speech and some information leading up to that, but I always record the speech on Fed Day because I like to watch the market and what happens in the market, once the Fed makes its announcements, and then what happens as Jerome Powell answers questions in the press conference that goes on afterwards, and how they show the tick by tick on the on when he says some new item, and how the market reacts to it. But before I dive into kind of the Fed speak and Fed review today, I wanted to make a quick update to yesterday's video where I was giving you guys some of the updated protein specials that were going on in Atlanta. And so Aldi came out today with one additional special that wasn't included in the preview that I saw last night. And that is they have Tyson fresh chicken wings for $2.49 a pound. Sale starts today for anybody in Metro Atlanta that cares. Okay. Then I started the morning out playing a quick game of solitaire and continued my streak. So now I'm up to 268 days of continuously winning at solitaire. So anyway, it was just fun this morning. Now, before I get into the discussion on the Fed and add my 2 cents, I want you guys to be able to hear directly from Jerome Powell. So I'm going to have a little bit of his speech, I think it's maybe 2 minutes, and I'm going to highlight next to what he's saying the key points that he brings up during the speech, and then I'll be back after the speech to actually go through and talk about each of the key items, and again provide my 2 cents on the information. And disclaimer right up front, I'm not an economist. I don't have any special training in this area. This is just one man's opinion of the data that he's hearing being presented. So I'll be right back.
Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December.
Okay, so I'm back. So let me start with the Fed's outlook on GDP. So the Fed's forecasting GDP to be 1.7% in 2025 and then to slightly uptick to 1.8% from 2026 going forward. So that means that the Fed believes that the Trump presidency will be a flop. And what I mean by that is that it's going to be a slow growth environment and that the promises of lower taxes and deregulation won't have any positive impact on the economy, or the impact will be offset by the tariffs he imposes and the immigration policies that he set. So, again, it's not a political statement. It's just, my point of view of how they're trying to balance out both sides of the equation. So that's going to imply, if you have the GDP that's staying in that range, which is way slower than it's been, since we've been coming out of the pandemic, that we're going to get into kind of a stock market equilibrium, well, an economy that's in an equilibrium, but a stock market that's also in an equilibrium, and that the pace that people are used to seeing their stocks go up is going to moderate substantially. And while I don't think that means we're going to go into a lost decade, if the Fed's projections hold true, you're going to see very low returns for the risk that you end up having to take in the market if you have a GDP that's in the 1.7% kind of range. So that's my thoughts on that. If we look at the Fed's unemployment outlook, the Fed sees unemployment, going from 4.1% now up to 4.4% by the end of the year. And the Fed doesn't differentiate between public sector, government jobs, and private sector. So it doesn't matter, if the layoffs, if you will, are coming from Doge and the federal government, or they're coming from the private sector. It all goes into the same pool. And I know that the administration thinks that the people they're going to get rid of in the government are going to find better jobs in the private sector, and then everything will balance out. Well, clearly, the Fed doesn't think that that's going to be the case, or we wouldn't see such a large uptick in the unemployment rate that they're projecting. And then they think once you have this uptick that you're going to enter into a steady state, for pretty much the rest of the Trump presidency, from that point forward. So they don't see unemployment coming back down to the 4% kind of rate. So that's kind of a surprise. And then, again, like I said, my comments aren't meant to be political in any way. I'm just tying back what the Fed's saying to the timeline in which they're projecting these numbers. And that's all. All right. So now let's talk about the inflation outlook. So they think that inflation will reach 2.8% in 2025 and then decrease in 2026 and 2027, implying that the Trump tariff inflation will be transitory, and they're going to kind of look through it, and it's going to be a short-lived event. So I guess people just get used to paying, substantially higher prices if that's what ends up getting passed through from tariffs. Again, Don't know whether it's going to, I know what's going to happen is come April 2nd, we'll learn, well, theoretically, we'll learn what's going to happen on reciprocal tariffs, what rates they're going to be, and then we'll know potentially what the impact will be on costs for the variety of goods that the tariffs are going to be um, placed upon, uh, and how that's going to impact our lives from a financial perspective. And then let's look at the SEP projections for interest rates. So the Fed is projecting that rates are going to come down from the current 4.25 to 4.5 down to 3.9% by the end of the year, and then they'll go down another half a percentage point in 2026, and finally another 300 basis points in 2027, and stabilize around 3% on the short end. All the people that I've listened to, um, while they think the short end will in fact come down over time, they're thinking that there's going to be a definite steepening in the yield curve. And based on a variety of the different policies, you're going to find things in the 10-year, 30-year rate, time frame. Those things are going to actually kind of raise the yield, so the price will drop and the yields will increase. If that's true, it won't be good for housing, it won't be good for car loans, etc., because they're all based off the 10-year. So I guess we'll have to wait and see. And then with the number of rate cuts that they're expecting, the median projection is for 2 rate cuts in 2025. And while I know some people are expecting them to come as early as June, if we do get 2, I don't think it's going to happen until at least October, and maybe October, December, kind of those 2 meetings. But I certainly don't expect it to happen by the summer, because I don't think the Fed will feel comfortable that they have enough data coming in from whatever tariff activities happened to be able to cut, which is why the other day I indicated when I did my latest bond purchase, I only did it for 3 months to come in 2 days after the next Fed meeting, because I expect the Fed to then hold. Once they do that, I'll be able to lock in the higher rates in the 4.3% range again for a longer duration. So anyway, that's my comments on that. And then I'd like to understand, what you think about both my comments on these items, what you think about the Fed's particular position on each of the areas. Do you think it is good for retirees to be going into that kind of environment or not? Let me know your thoughts in the comment section down below. And then I'm going to end the video showing you what I made for dinner tonight, which was my ribs with my low carb seasoning. So it was good. So anyway, that's my update and thoughts for today. I hope you're going to have a great evening. Again, if you have any questions or comments, please leave them in the comment section down below, or drop me an email at myretirementramblings@gmail.com. Otherwise, I look forward to talking to you tomorrow. Take care. Have a great evening.